Ladies and gentlemen, please welcome Peter Schiff, Chief Economist and Global Strategist of Euro-Pacific Capital. Peter Schiff is one of the few widely known economists and investment professionals to have spoken about the financial crisis before it began. He is a widely followed opponent of debt-fueled growth policies and known for his advocacy for emerging market and commodity-focused investments in countries with positive fiscal characteristics. Peter, thanks so much for leading off our first virtual expo in 2021.
Oh, thank you. I didn't realize that I was leading it off, but I'm happy to do that. And I wish, we could be doing this conference physically, but given the way things are, it's going to have to do virtually. But, in my introduction, you pointed out that I was warning about the 2008 financial crisis before it happened, which was the case. In fact, I was warning about it very vocally at many of the money shows that I attended leading up to that crisis. Well, I can assure everybody today that the crisis that's coming is going to be far worse than anything that was experienced in 2008. But it's going to be of a different nature, and there's going to be a different outcome. Of course, the cause is the same. It's the Federal Reserve and monetary policy, and to a lesser but also important extent, government fiscal policy, which is helping to drive the reckless monetary policy. But I think the way it's going to play out in the financial markets is going to be a lot different. Paul, is there a way that you could just make that a small little thing and not the whole screen? Sorry. It's going to be a lot different than it did in 2008. And this is the money show, and I think that is an appropriate title relative to what's going to be happening to our money. I think the important consideration this time around is going to be inflation. And I think inflation is the primary factor that everybody should take into consideration when trying to formulate an investment strategy, especially one that is going to do well in the coming decade. And you have to think of inflation not just as a monetary phenomena and not just as the effect that inflation is going to have on prices, and not just consumer prices, and asset prices. But you also have to think about inflation in its most basic form, which is taxation. Inflation is really a tax. I mean, that's basically what it boils down to. And you have to understand this, because governments really have two ways of paying for their expenditures. The most honest way is through current taxation. Now, obviously, that could be unpopular for the people who are paying the taxes, right? Nobody likes to send money to the US government. And so when politicians are constantly running for re-election, they don't want to have to tell the voters how much all these government programs cost. Now, there are certainly voters who benefit from the programs and couldn't care less about how much they cost because they're not the ones paying the taxes. But then you have the group of voters who are paying the taxes and who are not, directly benefiting from a lot of those programs. And so they're more cognizant of what they cost. So politicians looking to get as many votes as possible try to find other ways to finance their spending that won't aggravate the taxpayers. Now, another way that government could do it, which is really the first way, just delayed, is by borrowing the money. And I'm talking about borrowing it legitimately from a private lender who is willing to take money and loan it to the US government by buying a US Treasury bond from the government. Now, when governments do this, they're just delaying the taxation into the future, because whatever money the government borrows today must be repaid tomorrow. And where is the government going to get the money to repay the bondholders? Well, from the taxpayers of the future. But in the meantime, the taxpayers of today have to pay the interest on the money that's been borrowed. So in other words, when government pays for its spending programs by borrowing, the taxpayers are actually on the hook for an even greater cost, because not only do they pay back the principal, but they have to pay all the interest. It's just like if you go out, if you want to buy a new, let's say, television set, if you just buy it, it's cheaper than using a credit card and then paying your minimum payments every month. Because by the time you pay off the television set, maybe you've paid 2 or 3 times the actual cost because of all the interest that you've paid over the years. Well, that's the same thing. When you pay for government programs with debt, by the time you repay the debt, the government programs were a lot more expensive than if you had just paid for them with current taxation. But the benefit to politicians is that the taxpayers don't understand this, or they don't care, because they think it's some taxpayer in the future that's going to be stuck repaying the debt, not the taxpayers who are voting today. And by and large, that's how a lot of our government spending has been paid for until recently. See, now the government has to resort to a new method of finance, because it is now impossible for the government to borrow money from private sources, because it can't afford to pay a high enough interest rate to private lenders to make this a viable transaction. And that is because of the enormity of the debt that we currently have, right? The US government has borrowed so much money to try to delay the day of reckoning for so long and kick the can down the road as we've gone deeper and deeper into debt. Right now that we have a national debt that's approaching $30 trillion, right? There is no way that the US government can finance that. I mean, repaying the debt is completely impossible. I mean, not with money that has any real purchasing power. But at this point, the principal of the debt is just so enormous that even if the government was forced to pay a normal rate of interest, it could not actually make those payments. So what's happening now is that the government is financing its expenditures through inflation. And the way that process works is the government issues debt, and then it's the Federal Reserve that buys that debt. But when the Federal Reserve buys the debt, it has to expand the money supply to do it. See, when the US government borrows from a private lender, it's taking money from one person and loaning it to another. It doesn't increase the money supply, and the person who is loaning the money to the government can't also spend that money because they've loaned it to the government, and now the government gives it to somebody else to spend. But when the Federal Reserve monetizes that debt and prints new money, then it's all new spending in the economy, because the government hasn't taken money away from anybody, but it's giving new money to other people. And another way to think about it is, when the government taxes you to pay for its spending, it literally takes your money, right? Your money just comes right out of your paycheck. If it's an income tax, right? The government takes your money, and then they give that money to somebody else. And now somebody else spends the money that you earned. You can't spend it because the government took it and gave it to somebody else. So your standard of living, your purchasing power is diminished because you have less money to spend. But when the government doesn't raise your taxes, if it just prints money and then gives it to that same individual to spend, your purchasing power, at least in dollar terms, hasn't been diminished. But now you have another guy or gal who is given all this cash that can now go out and spend it. And so what happens is that person competes with you to buy stuff, and prices are bid higher. And so the result of that type of taxation is that prices go up, right? Everything becomes more expensive. So instead of the government taking your money, the government takes the purchasing power of your money, and that's a tax. And if you look at what's happening now, especially since the beginning of the pandemic, government debt and money printing is off the charts. I mean, we've never experienced anything like this. In fact, I think about half of the money that the government is now spending is being printed by the Federal Reserve. So it's not really borrow and spend anymore, it's print and spend. And right now, nobody seems to think that this is a problem, people seem to think that we've stumbled on the equivalent of a monetary fountain of youth. People like to call it modern monetary theory, which is we can have whatever we want as long as government prints the money to pay for it, that there's no limit, that government is free as long as they print money. Now, of course, why didn't we realize this in the past? I mean, why have we been paying taxes all these years if all we had to do is print money? After all, the printing press has been around for hundreds of years. And so if we could have whatever we want by the magic of government printing money, what's the point of all of us having to pay taxes? The reality is this is a fantasy that is going to end in disaster. See, there's a big difference between earning money and just having the government print it. See, when people are productive, when they have a job and they go to work and their labor is used to increase the supply of goods or services available to the public, right? You have a job, you do work, and your work either aids in the production of a good that people want or need, or you're helping to provide a service that people need. And in exchange for that help, you get money, you earn money, and now you can use that money to help buy the goods and services that you yourself help to produce, right? And the more productive you are, well, the more you earn, and therefore the greater share of what society produces, you are able to enjoy yourself. But when the government just prints money and gives it to you, right? When you have all these unemployed people who are sitting at home just getting a check from the government, they produced nothing. They added no goods or services to the economy, yet they can consume goods and services in the same proportions as if somebody had actually done work and actually been, a productive member of society. So what does this do, right? All this does is drive up prices, because if your work adds to the goods and services, and now you're consuming the goods and services you help create, that's fine. But if now you start consuming goods and services, yet you didn't help create any of those goods and services, you just have more money chasing a diminished supply of goods and services, and prices are going to go up. And they're going to go up like never before. And the irony of all of this is that the Federal Reserve has been promising Americans more inflation. Well, that's one promise that they're going to deliver on. In fact, they're going to deliver on it beyond their wildest expectations. And contrary to what everybody is saying, inflation is not a good thing. Inflation is not desirable. Higher inflation is not making progress, right? What people want is a lower cost of living. When prices go down, that's progress. And that's capitalism. That's how capitalism works. When you have real capitalism, businesses become more productive. They become more efficient. They develop economies of scale. And as they do that, the cost of production comes down. And as the cost of production goes down, demand goes up, because as prices go down, more people can afford to buy more stuff. And it's falling prices that have historically driven a rising standard of living. Well, the government has interrupted that benevolent process through inflation. And a lot of the times, inflation doesn't simply make prices go up. Inflation also prevents prices from going down. And a decline in a price would have been a windfall for the consumer. When the consumer is denied that windfall by government, it's still a tax. The government is still taking your purchasing power because the goods and services that you want to consume are more expensive as a result of the government inflation. Now, of course, a lot of the inflation that government has been creating since the 2008 financial crisis, a lot of that inflation has temporarily moved into asset prices. That's the stock market, the bond market, the real estate market, the market for collectibles or other things that are in short supply. And so when inflation pushes up asset prices, people don't complain, because the people that own those assets, of course, feel much richer. Now, if you don't own those assets, obviously it's problematic if you want to buy it. For example, if housing prices keep going up and you don't own a house and you want to buy one, the fact that prices keep going up, that's not a good thing. Now, the way the government has offset that is by keeping interest rates artificially low so that people can afford to overpay for houses as the prices keep going up. But again, all of that helps distort the economy and fuel the bubble. But beneath the surface, consumer prices have been rising. For all this talk about deflation, we haven't had any. For all the talk about an inadequate increase in the CPI, consumer prices have been going up despite the government's best effort to hide that through the CPI. I mean, if you think the CPI is giving you an accurate read on inflation, that'd be like assuming the mafia is going to give you an accurate report on crime. I mean, clearly, if you hired the mafia to study crime, you wouldn't be surprised to find that they said that there wasn't any, and therefore there's no need for more police because there's no crime. The last thing the government wants is for the public to realize how much inflation there is. They certainly don't want bond investors to realize that. The key to sustaining the bubble economy, the key to sustaining massive and unsustainable government deficits in the short run is artificially low interest rates. And the Fed's only justification for keeping interest rates artificially low is the preposterous idea that there's not enough inflation. And therefore, they need to keep rates low in order to make consumer prices higher. But again, it's absurd to believe that consumers want higher prices. If they really did, then stores would advertise price hikes instead of price cuts. They wouldn't make a big deal about having a sale. They would send out notices, hey, hurry up and buy, we just raised our prices. Consumers don't enjoy increased prices. They look forward to decreased prices. So this is all a ruse because the government is trying to justify a reckless monetary policy that is designed to protect the government, not the economy or not the people. But we're about to suffer the consequences of all this inflation in a way that's far greater than what I even imagined when I first began coming to these money shows. And a lot of that, too, has to do with what's happened during the pandemic, which is obviously not an event that I had built into my forecast, but nonetheless is simply accelerating everything that I have been forecasting and will make it worse. Because a lot of people, their initial response to the pandemic was, oh, this is deflationary, right? This means people are not going to have demand for things because they're staying at home. Well, that's true. A lot of people stayed at home, and so they didn't buy as much, airline tickets or stay in hotels, but they had no problem shopping on Amazon. And so it wasn't that demand stopped during the pandemic. It just transferred. Money that consumers weren't spending traveling, they simply spent it on other things. And a lot of people, unfortunately, because of our politicians, a lot of people ended up with more money being unemployed than they had when they actually had jobs. And that was because the government's unemployment benefits were so generous. You had people earning double, and in some cases triple, not working than what they earned when they actually had jobs. And so a lot of this money was spent. In addition, you had a lot of people who were told, hey, you don't have to pay your rent. You're not going to get evicted. So you had a lot of people that didn't spend money on rent, but now had extra money to buy other things. So there was a lot of spending going on during the pandemic. And a lot of that spending was on imports. That's why our trade deficit in goods is at an all-time record high. We are importing more goods than ever before. Our total trade deficit, when you count our surplus in services, is the highest it's been since 2008, just before the financial crisis. And I think within the next couple of months, we are going to break that record, which means, despite what Donald Trump promised as a candidate, the trade deficit is much worse as his presidency is coming to an end than it was when he inherited the economy from Obama. And in fact, the trade deficits were getting bigger even before the pandemic. They just accelerated faster after it, given the bubble nature of our economy and the fact that our manufacturing sector had continued to deteriorate on Trump's watch. And of course, it's going to get even worse now that Biden's there. And of course, it's both deficits. The budget deficits have exploded beyond anything. In fact, we don't have the final numbers yet, but I think it's possible that Donald Trump may have added more debt in 4 years than Obama did in 8. And if you recall, President Obama added more debt during his 8 years than all the presidents before him, from George Washington to George Bush. And then Obama comes in and adds as much. And now Trump has done that in half the time. And now we're heading into the Biden administration. So again, the point I'm making here is that the pandemic increased this demand, but also decreased supply. What happened during the pandemic and what is still happening? People didn't go to work. Factories shut down. Supply chains got bogged down because there was nothing being supplied. So as demand was coming up, supply was going down. Governments around the world are printing all this money as factories are shutting down, as mines are shutting down. So we're getting less production of stuff, but we're getting a lot more production of money. Meanwhile, companies took on unprecedented amounts of debt. Governments took on unprecedented amounts of debt to do the wrong thing. What should governments have done during the pandemic? They should have cut government spending. They should have recognized that the economy was in trouble, and the way that you help an economy is by reducing the burden that government places on that economy. Government exacts a cost because government produces nothing. Government lives off the productivity of the private sector. Well, if the private sector is thriving, then the government can take some of those resources. But when the private sector is struggling with pressures like the pandemic, government needs to be smaller. Government needs to cut back and free up those resources back to the private sector so it can use them when it needs them. Instead, we did the opposite. We compounded the problems by increasing the toll exacted by government. And so we have more debt than ever before, more money creation than ever before, and we have created an economy that is more dependent on debt and money printing than ever before. That is why inflation is about to go through the roof. And again, think about it as a tax. The government is about to take most of what you have, not through taxation. Now, they're going to increase taxes. There's no question that the Biden administration is going to raise taxes. And if you think otherwise, you're delusional. There's going to be a big tax increase on corporations. There's going to be a big tax increase on higher earners in form of capital gains or ordinary income. But the main tax that is going to hit everybody is going to be inflation, especially if you're poor or middle class and you're working and all you have is your wages, and those wages are going to be dramatically diminished in value because of inflation. But probably more important to this audience, if you are a saver, if you are retired, or if you are nearing retirement, you are about to be decimated. Your entire life's savings is about to be taxed away by inflation. Government spending is going to go through the roof under Biden. It already went through the roof under Trump, so the roof is gone. It's just going to the sky. Because if Trump was as reckless with a Republican Congress, imagine how much more reckless Biden is going to be with the Democrats controlling Congress. Biden is inheriting a $3 or $4 trillion deficit. You think that deficit's coming down? No. And the Fed is going to have to print more and more money. The balance sheet is already, $7.5 trillion. It's going to go through 10 trillion this year. Maybe it could get to 15 or 20 trillion next year. The dollar is going to be destroyed. That's why the US dollar is already falling, despite the fact that all the experts predicted it would rise. It ended 2020 with a loss, and now it's poised for a much bigger loss. The price of gold rose and made a new high. It got above $2,000 an ounce, rising from $1,050 in the end of 2015. The stage is already set. Look at oil prices. They're at $53 a barrel now as I speak. Oil prices are going to shock people this year, probably by how high they can climb. Look at what's already happening to industrial metals. Look at nickel. Look at copper. Look at commodities. Look at soybeans in the teens. Everything is getting more expensive. And the Fed is still pretending that we don't have enough inflation as they're throwing gasoline on the fire. So what do you do? How do you invest in the era of inflation? Well, go back to the first decade of this century, and that will give you a playbook. You can also go back to the 1970s and see what performed well during that decade. But what we're about to experience is going to be so much worse. But if you go back to that time period, and again, you don't have to go back to the 70s, just go back to 2000 and 2010 decade, and that's when the Fed was printing all the money to kind of stimulate the economy after the dot-com bubble burst, and what they did to try to push up housing prices, and then how they reacted immediately to the bursting of the housing bubble. What did well? The dollar fell dramatically from 2000 to 2010. Dollar index was about 120, and it went down to about 70. Oil prices went from about $20 a barrel to 150. Gold went from under 300 to 1900. Silver went from $4 an ounce to $50 an ounce. Emerging markets just killed it. They were up 400 or 500%, while the U.S. stock market went down. Right, the first decade of this century, the S&P went down in value, and of course, the real value of U.S. stocks was down even more if you measured them in foreign currencies or if you measured them in the price of gold. Well, the dollar is going to be a lot weaker now than it was then. I think metal prices, gold prices, other commodity prices are going to be much stronger in this decade than they were then. And so I think the relative gains that investors will enjoy by investing in overseas markets will be even greater than the big gains that they enjoyed in the first decade of this century. And if you go back to the 1970s, what were the good investments of the 1970s when we had stagflation? This time it's going to be worse stagnation and worse inflation. What happened? The Deutschmark tripled, the yen tripled, the Swiss franc tripled. Gold went from $35 an ounce to $850. Oil went from $3 a barrel to $30 a barrel. I mean, it was huge increases in commodity prices as the dollar collapsed. The only reason the dollar stopped falling in 1980 was because we had Ronald Reagan coming in, and we had Paul Volcker allowing short-term interest rates to rise to 20%. We have a current Fed that can't even let interest rates rise to 2%. In fact, we can't even afford 1%, let alone 2%. That's how broke we are today compared to 1980. 1980, we were still the world's biggest creditor nation. Now we're the world's biggest debtor. Back in 1980, we still had trade surpluses. Now we have massive trade deficits. So this is going to be a massive change. I think the dollar is going to not just decline, but collapse. I think the next crisis is not just a financial crisis, but a dollar crisis. And so the most important thing that you could do now is to completely divest of U.S. dollar assets. You got to get out of U.S. bonds in particular. Bondholders are going to be the biggest losers as the dollar collapses, because all bonds are promises to be paid dollars in the future. And as little as dollars buy now, they're going to buy a lot less in the future. U.S. stocks are way overpriced, and their earnings are predominantly in dollars. Sure, you have multinationals that are earning foreign currencies, but a lot of their earnings come from the U.S., and those earnings are A, going to decline, and B, are going to be worth less. But of course, taxes are going up. So whatever American companies end up earning, there'll be less of it available for their American shareholders because of higher corporate taxes. It's going to be foreign markets, emerging markets in particular, that are going to benefit dramatically from the declining dollar, because a lot of their debts are in dollars, and basically their debts get wiped out as the dollar declines, and that is rocket fuel for their economies. The standard of living outside the United States will rise as it falls in the United States, because as the dollar declines relative to other currencies, that means that foreigners can now consume more of what's produced and Americans consume less. And so as our living standard falls, theirs rises. You want to own businesses that are profiting from that are selling to wealthier foreign consumers, not the ones that are stuck with American consumers who are now broke. I mean, Americans have been using credit to buy because they haven't had the incomes. Well, their credit's going to dry up as the dollar collapses. So these emerging markets are going to boom. Investments that are linked to commodities are going to do extremely well. Countries that have a lot of commodity-based exports will do well. And of course, the countries that have less government on a relative basis and therefore have more economic freedom, have fewer regulations and lower taxes, will do much better than those that have more government, more regulations, and higher taxes. And so that's what we're doing at Europe Pacific Capital. I would encourage the people who are here to contact us, europac.com, europacificfunds.com, to learn about our strategies. I manage money. I have 5 mutual funds in my family, which you can purchase at any of the major brokerage firms around. You can get information on the funds at europacfunds.com. Read about those. Gold, Schiff Gold is my company. You need to own physical gold as a safe haven, as a store of value. Don't get conned into Bitcoin. Bitcoin is a bubble. Bitcoin isn't a safe haven. It's not a store of value. You can't store what you don't have. When you own gold, what you're doing is storing the future use of gold as a metal. People need gold. They'll always need gold. Jewelers need gold. Computer chip manufacturers, the aerospace industry, dentistry. Gold is the most useful, the most valuable metal on the planet, and it doesn't decay. So you can store it and preserve the value to be used in the future. Bitcoin has no use and no value today. It is just a Ponzi scheme and a pyramid scheme kind of rolled into one. So stay away from that. But you need to have real portfolios, real assets, good stocks that pay dividends in foreign currencies, and have a focus on the investments that are going to thrive as the dollar does not. And most Americans, I think, are going to get completely blindsided by this crisis, even more so than they were by 2008. The big difference is the government was able to bail all those people out in 2008 by printing money. They're not going to be able to do that again because it's the money that's the crisis. It's the U.S. government itself that's going to need a bailout, and the Fed's not going to be able to do it with money that nobody wants. So you need to help yourself in advance, and I can help you do that. But I think time is running out, so don't wait. And I think my time has run out for the presentation if my clock is correct. So thanks, everybody, for listening.
Hey, Peter, thank you so much. We really appreciate your time. Do you have a minute for a question or two?
Oh, yeah. I didn't know we had any Q&A, but sure.
Yeah, you've got. I've got lots of questions for you, but we do have a couple minutes if you're okay with that.
Okay.
What's your best gold play?
Well, gold is a very risky business. I mean, gold mining. I mean, gold, just buy physical gold. Everybody should have some money in physical gold. Stay away from numismatics or collectible coins. I mean, that's a whole different animal. So, Schiff Gold, we don't even sell those. I mean, we could, but we try to discourage people from, collecting coins. You just want to own bullion and you want to get it as cheap as possible. But gold is to preserve your wealth, right? You're not going to get rich owning physical gold. You'll avoid going broke. But if you really want to, get rich or, get a lot richer, gold stocks, I believe, have enormous potential. I think some of these stocks can go up 10 times, 20 times, 50 times. So I think a lot of money is going to be made in gold stocks. Of course, there's a lot more risk in gold stocks. I mean, no pain, no gain, right? You can't get big returns unless you're willing to take big risks. But I think the upside potential is enormous compared to the downside risk. So if you are a risk taker, I think these risks make a lot of sense. And I think the best way to do it, rather than just trying to pick a stock yourself and hope that you pick the right one, hire a professional manager who's been doing it for 30, 40 years. And that's what I've done with Adrian Day. He manages the Euro Pacific Gold Fund. I think my gold fund is going to crush it. I think we're going to kill our competitors. I think we have a real advantage in Adrian's skills at understanding which gold stocks to buy and which to avoid. So I think we're going to beat the indexes that just buy everything, and we're going to beat other managed funds where the managers are not as good as Adrian. So the Euro Pacific Gold Fund would be what I would suggest. If you really want to play gold and you want a way to make a lot of money, it's in the mining stocks, and I think my gold fund is the best way to do it. And of course, we also offer separately managed accounts. So if you have a larger amount of money, we will manage a personal portfolio for you in gold and silver mining stocks. And again, Adrian is the manager of the portfolios, just the way he manages the fund.
All right, thank you, Peter. And do you find foreign stocks in developed and or emerging markets attractive? And how would you allocate among those stocks, all cap as well as precious metals?
Well, a lot of the stocks that we follow are undervalued, and we own those stocks. I mean, there are certain stocks that are expensive, and we may buy them in the future if they're no longer expensive. But fortunately, there are quite a few stocks out there that are objectively cheap. And they're cheap based on their earnings, based on their dividends, based on their book value or other historic metrics that you can look at the stocks. But one thing you know for sure, if you just look at the total market, if you look at emerging markets, for example, the total market cap versus the US, they've never been this cheap, right? So it's never been cheaper to buy emerging markets relative to buying the US market. And the US economy has actually never been in worse shape fundamentally than it is right now. So it makes no sense. I mean, even if my apocalyptic, outlook is incorrect, just a mean reversion trade, it makes no sense to buy the US when emerging markets are so cheap and when their growth rates are much better and the economies are in better shape. But I think we are headed for that apocalyptic dollar crisis. I think that, the day of reckoning is coming for America. It's unfortunate. We've been living beyond our means for a long time, and those chickens are coming home to roost. And the people who don't understand this are about to lose a tremendous amount of wealth. The people who do understand it can avoid those losses and actually profit if they do the right thing.
All right, great. Well, can you share any emerging markets, though, that you do like? Anything specific?
Yeah. Well, first of all, of course, I have an emerging market fund. It's Europe Pacific Asia Small Companies, and it's all over emerging markets, but it's particularly focused in Asia. And so that answers your question. I think the emerging markets that look the most attractive to me are in Asia, and because that's where you generally have the least amount of government, the nations that have the biggest trade surpluses, lower regulation, better demographics, and you have populations that are not looking to government for a handout. They're looking to themselves. There's more self-sufficient. They're more like what America used to be than what America has become, right? I find nations that have more in common with America's past than what we do. We now have more in common with the big socialist countries of the world, the big government spenders, the big money printers, those economies that have collapsed. Whereas you can find other countries that have more in common with what we used to be, which is why we were so successful. So I think those emerging markets look the best. But also any of these emerging market economies that have a lot of US dollar debt, but also export a lot of commodities, that have a lot of raw materials, agriculture, industrial metals, stuff like that. I mean, these economies are going to do very well as the value of their exports goes up and the cost of servicing their debt goes down.
All right. Well, thank you so much, Peter, again for joining us today and helping us kick off our session for 2021.
Okay, my pleasure.